You've watched the investing video. You know about compound interest. You know you're supposed to start early. None of that is the problem. The problem is that most money advice stops at the fun part, the returns, the charts, the millionaire math, and skips the boring half that actually determines whether any of it happens. 9 habits. The first 3 cost you nothing. The last one changes how you read the other 8. Free money doesn't ask twice. Somewhere in your paycheck is a return no investment on earth can match, and most people walk past it every 2 weeks. Here's what you're actually doing: contributing just enough to feel like you're doing something. Or worse, contributing nothing because retirement feels far away and rent doesn't. Meanwhile, your employer has a match sitting there, unclaimed, quietly expiring. A 50% match up to 6% of your salary means every dollar you put in becomes $1.50 the instant it lands. Not over a year. Not after market performance. Instantly. There is no index fund, no stock, no crypto cycle that guarantees 50% overnight. This is the one guaranteed return you will ever be offered. Here's the part nobody mentions. People will spend hours researching which ETF to buy while leaving a guaranteed 50% return unclaimed, because the match doesn't feel like investing. It feels like paperwork. It isn't. It's the highest return decision available to you, and it takes 10 minutes to fix. Protocol: check your contribution percentage against your employer's match threshold this week. If you're below it, raise it to the match line before you do anything else on this list. The rule: claim the free money before you optimize anything else. Open your payroll or benefits portal right now before you finish the video and check the number. Time you can't buy back. 2 people, same $100 a month, same 8% average return. One starts at 20. One starts at 25. The 5-year gap costs the second person roughly $177,000 by retirement, despite having invested only about $66,000 less. You tell yourself you'll start once you're stable, once the raise comes, once the timing feels right. The timing will never feel right. That's not a character flaw, it's just how money conversations work. There's always a more urgent expense standing in front of the long-term one. The mechanic is simple. Money invested early doesn't just grow, it grows on its own growth. Year 1's gains earn gains in year 2, which earn gains in year 3. A dollar invested at 20 has 45 years of that cycle running. A dollar invested at 30 has 35. Now flip it. This isn't a lecture about discipline. It's math about a clock that started before you were paying attention. The 5 years you save by waiting aren't free. They're the most expensive 5 years in the whole timeline, because they're the ones compound interest never touches. Protocol: if you're not investing anything right now, start with an amount small enough to not notice, even $25. This week, not next quarter. The rule: start before you feel ready, because ready is a moving target. Set the transfer up today. Not this week, in theory. Today, while it's still in front of you. The market doesn't care what you think. Every investor believes quietly that they're the exception, that they'll read the signs correctly and get out before the drop, back in before the rally. You watch the headlines, you see a dip and think, not yet, it might go lower. You see a rally and think, too late, I missed it. Both thoughts feel like strategy. Both are guessing dressed up as analysis. Here's the mechanic. The market's best days and worst days cluster together, usually inside the same volatile stretch. Studies tracking decades of S&P 500 performance consistently show that missing even a handful of the best trading days over 20 years drags annualized returns down dramatically, in some measurements close to inflation. You can't dodge the crash without also risking the recovery that follows it, because they often sit days apart. Here's the actual trick. You don't need to know which days those are. Staying invested means you're there for them by default. Trying to time it means you're betting you'll correctly guess both an exit and a re-entry point. Twice the odds of being wrong. Protocol. If you're holding cash, waiting for a dip, pick a date this month to invest it, regardless of price, and commit to it now. The rule. Time in the market beats timing the market every measured decade. Pick the date now, not after you finish watching. A date you set later is a date you'll move. If you can't explain it, you don't own it. Somewhere between everyone's talking about it and the price is already moving, people buy things they couldn't explain if you asked them to. You see something trending. You see a chart going up and to the right. You don't fully understand how it makes money, what makes it risky, or how long you'd need to hold it. But the fear of missing out does the deciding for you. This isn't about needing a finance degree. It's a lower bar than that. Can you say, out loud, how this investment generates a return, roughly how long you'd need to hold it to see one, and what kind of drop you could stomach along the way? If the answer is no on any of those, you don't have an investment. You have a guess with a ticker symbol. Here's the part nobody mentions. Not investing in something you don't understand isn't caution. It's just accuracy. You're not protecting yourself from risk. You're refusing to pretend you know odds you don't actually know. Protocol. Before your next purchase, write down in one sentence how it makes money. If you can't finish the sentence, don't finish the trade. The rule: understand it before you own it, not after. Look at whatever you currently hold and try to write that sentence right now. If you can't, that's today's answer, not tomorrow's. Money has a deadline. Not all money is the same money, even when it's sitting in the same account. You treat your savings as one number, a lump sum you could theoretically move around freely. So when the market's up, you're tempted to chase it with money you'll actually need in a year for taxes, a deposit, a plan you already made. Here's the mechanic. Markets can drop sharply with no warning. Investments have lost 50% or more in the span of weeks before, and there's no guarantee of when they recover. Money invested with a 10 to 20-year runway can absorb that. Money you need in 18 months cannot. You'd be forced to sell at the exact wrong moment. Now flip it. This is the same mistake as Module 3, wearing different clothes. There, the problem was guessing when to move money. Here, the problem is not separating money that was never supposed to move in the first place.
Protocol. Separate anything you'll need within 3 years into cash, a high-yield savings account, or a money market fund. Somewhere the number can't drop. Everything else can go long-term. The rule? Match your money's timeline to its purpose, not its potential. List every near-term expense you know about right now, and check whether the money for it is actually sitting somewhere safe. Your raise already left. Income goes up. Somehow, the amount left over at the end of the month doesn't. You get the raise. The apartment gets a little bigger. The car gets a little newer. None of it feels like overspending. It feels like finally catching up. But your savings rate, measured as a percentage of what you earn, hasn't actually moved. You're making more and keeping the same share you always did. This is lifestyle inflation, and it's invisible, precisely because every individual upgrade feels reasonable. Nobody sits down and decides to stay financially flat forever. It happens one plausible expense at a time. Here's the actual trick. The fix isn't refusing every upgrade. It's automating the gap before you see it. When a raise hits, route half of the increase straight into savings or investing before it ever touches your regular spending account. You still get to enjoy some of the raise. You just don't let all of it evaporate into a slightly nicer version of the same life. Protocol. Next time your income increases, move at least half of the increase into savings the same week, automatically. The rule: let your savings rate rise with your income, not just your spending. If a raise is already sitting in your account, set the automatic transfer up before you spend another paycheck at the new number. The fee you never see. A 1% fee sounds small enough to ignore. That's exactly the problem. You compare investment options by their headline returns, maybe their risk level, rarely their fees, because a 1% expense ratio doesn't feel like anything happening. Nobody sends you a bill for it. It's just quietly subtracted, every year, forever. Here's the mechanic. Fees compound the same way your gains do, except backward. A 1% annual fee versus a 0.05% fee doesn't cost you 1% once. It costs you a growing slice of a growing balance every single year for as long as you hold the investment. Over several decades, that gap can add up to a meaningful fraction of your entire portfolio. This is the same problem as Module 6, wearing different clothes again. Money leaking out in amounts too small to notice individually, large enough to matter in total. Protocol. Look up the expense ratio on whatever you're currently invested in. If it's meaningfully above 0.1 to 0.2% for a comparable fund, that's worth understanding why. The rule: the fee is a fixed cost, so let it be a small one. Search your fund's expense ratio right now. It's public information you've probably never once looked at. Debt needs a deadline. A number without an end date isn't a plan. It's just a weight you carry indefinitely. You know the balance. You might not know the date it hits zero. Because credit card debt, especially at 20% plus interest, is designed to feel permanent. You make the minimum payment, the balance barely moves, and the whole thing starts to feel less like a problem to solve and more like a fact of life. Here's the mechanic, and it's the least glamorous math on this list. Paying off a card at 24% interest is mathematically identical to an investment guaranteed to return 24%. No investment on this entire list promises that. High-interest debt isn't competing with your investing goals. It's outperforming them in the wrong direction. This is exactly the kind of thing MoneyFlow's debt tracker is built for. It doesn't just show the balance, it calculates an actual payoff date based on what you're paying. So, someday becomes a number on a calendar. Links in the description. Protocol. Find the actual interest rate on your highest rate debt this week. Not the payment, the rate. The rule: give your debt a deadline before you give the market more money. Pull up your statement right now and find the APR. Not the minimum due, the actual rate. Income was never the score. Everything on this list so far was either adding to one number or quietly draining it, and almost nobody tracks the number itself. You measure progress by income. The raise, the offer, the number on the paycheck. Income feels like the scoreboard because it's the number you see most often. But income says nothing about what you're keeping, Someone earning $200,000 with $180,000 in debt is behind someone earning $60,000 with no debt and steady savings. And income alone would never tell you that. Here's the turn. Go back through this list. The employer match, the early start, staying invested, understanding what you own, matching money to its timeline, letting savings rise with income, minimizing fees, killing the debt. Every single one of those either builds or protects one number, net worth, not income, what's actually left when you subtract what you owe from what you have. Protocol. Calculate your net worth once, assets minus debts, and check it again in 3 months. Not daily, just enough to see the direction it's moving. The rule: track what you keep, not what you earn. Add up everything you own and subtract everything you owe today. One number. Write it down somewhere you'll see it again. Claim the match. Start before you're ready. Stop guessing the market's next move. Understand what you own. Match your money to its deadline. Let savings rise with income. Kill the invisible fees. Give your debt a finish line. And measure the number that actually moves. Net worth, not income. None of these are exciting individually. Together, they're the whole game. If you want an easier way to see that number move, MoneyFlow tracks your net worth automatically. No bank linking required. Links below.